Today we're going to have a video. You see on your screen a general journal, and to the right of that some entries. I'm still not convinced that you're completely clear about journalizing. In other words, entering journals in the book of original entry called the journal. Many of you have the assignment from last Friday out as well, and I need to see that. But maybe by looking at this, going through this with me, maybe it will clear up some things before you complete that assignment. So what I'm going to do is go over this with you, watch on the screen as I do these entries and explain what should be happening. You'll see that this is a company called Richard's Sporting Goods, and there are some transactions listed on the right for the month of March of 2017, and these need to be entered into the journal. So we will do this on the screen, so follow along, take notes if you need to. First of all, the first entry dated March 1, 2017, so we will put in the date in that column, March 1, 2017. We made sales on account. We have to consider which two accounts were involved here. Sales on account, which means we made sales. Sales is a revenue account. That should go up. When a revenue account goes up, it's credited. And the credit part is always the second part of the entry. We made sales on account. Customers charged these purchases. In other words, we did not get cash. But what we got is an asset account that went up called accounts receivable. That's the debit part of the entry. Accounts receivable means that somebody owes us money. Customers owe us money. It's an asset account. It goes up, so we need to debit that amount by $980. So asset account, accounts receivable went up. We made sales on account. The other part of the entry is the credit part. We did make sales. Sales, as I said, is a revenue account. Revenue accounts go up on the credit side. Credits are the increased side of sales account. So 980. Then we need a description. Very simple. Made sales on account. Very simple. So that's the entry for that. You have a debit part, you have a credit part. You have to understand the two accounts involved, what kind are the accounts, and then which is the debit. Well, the debit is the accounts receivable because that's what went up. We gained an asset. People owe us money, so that's what's debited. Sales is a revenue account. You should know that all revenue accounts are credited when they go up, and so in the credit column, 980. Next entry, March 2nd. We made sales for cash. Very similar to the first one, except this time we got cash. Cash went up. Cash is an asset, so we put cash and we debit by how much? 412.98. Cash is an asset. It went up. We got cash, so we debit. We also made sales, just as in the first transaction. Sales is credited. It goes up by the same amount. Okay? Description: made sales for cash. All right? March 3rd. In this transaction, the store bought some inventory on account. Which two accounts were involved? Well, inventory is involved. Inventory, you should know, is an asset account. We got inventory. Obviously, inventory then went up. So inventory is an asset. Whoops, inventory. Let me spell it right. Is an asset account. It went up, so we debit, and the amount is $10,000. Okay. What's the credit part? Well, we bought inventory on account. We didn't pay cash for it, so we're not going to credit cash, but we charged it. When we owe something, that's a liability. In this case, we will use accounts payable, and we will credit by the same amount, $10,000. So we owe now $10,000, but we gained inventory, so it went up. That's our transaction. Inventory debited, accounts payable credited. Okay? Basically, the description is the transaction we see on the right. So we bought inventory on account. That means we charged it. Next one. March 4, 2017. What happened here? The store paid the electric bill for cash. Which two accounts? Cash is involved, obviously. Since we wrote a check 316, obviously cash is going down. So probably we'll credit cash, right? What's the other part? Electric bill. Is that a liability? Did we get an asset? We did not. If you're using a liability, you're gaining an asset. Electric bill is the cost of doing business. So this is probably going to be described as electric expense or electricity expense. Okay? When an expense goes up, and it is, we've now paid more for electricity. It went up. So when an expense goes up, you should know that it is debited. So 329.76. That's the debit part. What happened with cash? We did pay cash, right? We wrote a check. We must have paid cash. So cash went down. So when an asset goes down, it's credited by the same amount. And that's how much we wrote the check for. So paid cash for an electric bill. That's our description. Okay? So if it's an expense, electricity would be an expense, cost of doing business. Expenses goes up, and when expenses go up, they're debited. We pay cash. Cash is an asset. When an asset goes down, it is credited. So you see it debited, and then you see it credited. March 5th. Store paid on account for inventory that the store charged on March 3rd. Okay, think about this. March 3rd, go back to March 3rd, store bought some inventory on account. They charged it. Now we're paying for part of it. The store paid on account for the inventory that the store charged back on March 3rd. We're paying $1,500. Okay, so we're paying money, so cash is going to be involved. Cash went down, so cash would be the credit part. What's the debit part? Well, up here, when we bought the inventory, we see it here. We bought it for $10,000 and we credited it because we owe more money. Now we're paying a little bit of it off. So accounts payable, which is a liability, increases on the credit side when we originally bought the stuff. Now we're paying part of it. So accounts payable will go down. A liability decreases on the debit side. Somebody have to remember that. Accounts payable is a liability, and liabilities decrease on the debit side. So we paid $1,500, and since we paid it, obviously, we paid cash. So we paid cash of $1,500. It's an asset, it went down. So we paid on account check number 317. Okay. Now up here we probably should have put the check numbers in as well. We paid cash for an electric bill. That was $316. So in the description, it may help to add that to it, just to clarify. Okay. So again, accounts payable is debited because it's a little bit less. We paid part of that $10,000 bill that we charged back on March 3rd. And so accounts payable goes down, it is debited. Cash also goes down. And that happens frequently. Two things go up or two things go down, but there's always one debit, one credit. Cash is credited because it's an asset. When it goes down, it's credited. March 6th, store bought office equipment for cash. We got office equipment. That is an asset. I think that would be pretty obvious. So it would be debited. When an asset goes up, it's debited. Office equipment goes up by $812.34. And how do we pay for it? We pay cash for it. So cash is credited. Asset account goes down because we pay cash, and by the same amount, $812.34. Okay. So description: bought office equipment for cash. Check. Number 318. So that's our description. Okay, last one. March 7. Okay, this is kind of a new one. We haven't had this one before. Paid salaries to employees. Salaries is an expense. It's a cost of doing business. We don't gain an asset directly when we pay salaries. We just have to do that. Otherwise, obviously, the employees are not going to stay with us. So it's an expense. It's part of doing business. So we have an account, very common, called, salaries expense. And we paid $4,800 to our employees. And what did we do? We paid cash. They got money. We paid cash. So cash goes down, asset account decreased by $4,800. And the description is a little different because we paid salaries, and companies would have a different kind of checking account for payroll. So they use a payroll checking account. And we had 6 of them, so we might as well put that in. Paid salaries, 6 payroll checks. We don't necessarily need to write out every single number on the payroll checks, but this describes what happened. So again, when we pay employees, think about this. This is an expense because it's a cost of doing business. We don't gain a direct asset when we pay salaries. We just have to do it to keep the business going. So that's an expense. When the expenses increase, they are debited. When we pay that, we pay cash. When cash as an asset decreases, it is credited. So there's your correct entries for these transactions. What you might want to do is to go over this maybe a couple of times. Again, look at the transactions, look at the entries in the journal, and see if you can make sense of why certain accounts are debited, which ones are credited. You need to simply memorize the kind of account, what's debited, what's credited, what's increasing, what's decreasing. Always remember you have a debit credit every time, but you need to understand the accounts involved in each one. So as I said, you might want to go over this a couple times because we will be doing more of these, and I'll expect that you understand what this is all about.